Hello and welcome back to Behind the Money, the show where we talk about some of the most interesting public companies and people. I'm your host, Morris Willie. Today, we're doing something a little bit different than our more recent videos. Today, we're talking about Armour Residential REIT, ARR, why you shouldn't be buying it anytime soon. While watching Behind the Money, remember, this isn't financial advice and shouldn't be taken as financial advice. This is only for entertainment purposes only. Now, back to the video. Let's get into a bit of a background of the stock. Armour Residential REIT is a Maryland corporation incorporated in 2008. Armour and its subsidiaries managed by Armour Capital Management LP, an investment advisor registered with the SEC. They invest primarily in residential mortgage-backed securities issued or guaranteed by a United States government-sponsored entity such as the Federal National Mortgage Association, Fannie Mae, the Federal Home Loan Mortgage Corporation, Freddie Mac, or guaranteed by the Government National Mortgage Administration, Ginnie Mae. The company's agency securities consist primarily of fixed-rate loans. The remaining are either backed by hybrid adjustable rate or adjustable rate loans. From time to time, they may invest in interest-only securities, U.S. Treasury securities, and money market instruments. Something else to note about the company, that since its inception in 2008, ARR has paid out $2 billion worth of dividends. Now, if you've been around for a while, you know I've talked about ARR in the past, but what now makes it a strong sell candidate? For one, the current dividend is currently at 19%. Some would say that this is somewhat of a dividend trap, and some would even question its sustainability. When the stock was at $10, a 96-cent dividend would make sense, but now with the stock at $5 and now going below $5, a near 20% yield could be dangerous for current shareholders or someone looking at the stock that wants to get in. Now, looking more closely at their earnings from last month, something that sticks out, like I've seen with many of REITs recently, is that their book value is slowly decreasing. At the time of their earnings report, their current book value per common share was $5.38. That means that technically it's over their book value, so that's good, but they're still paying out a massive dividend to shareholders, and with interest rates increasing and everything that's going on in the economy right now, I wouldn't be surprised if their book value were to end up decreasing even more, which subsequently will probably lower the share price. Going even further to look at some of their numbers, currently the company has a market cap of $1.15 billion with total debt of $9.3 billion, but they do have cash on hand of $12.34 billion, so that's good. They have enough cash to technically cover their total debt, but some of their numbers are kind of alarming. Like you have total debt to equity, TTM, which for ARR is 711.85% compared to the sector median of 66.34%. Now, the sector median might be a little off because you have the average dividend in the sector with 3.75% compared to 21.5%. But what we have to remember here is ARR is a mortgage REIT, so mortgage REITs are going to have higher dividends. So that is something to keep in mind. But going back to alarming numbers, their total debt to capital right now is 87.68% compared to the sector median of 40.29%. The company's earning revisions are also down 100% technically, with 3 analysts giving it 3 down revisions. Here's some good news though. Their second quarter earnings were positive compared to their negative first quarter earnings, and their third and fourth quarter estimates are also positive, with their revenue estimates being $61 million for the third quarter and $65 million for the fourth quarter, compared to their $54 million earnings for the second quarter. Finally, what do analysts think of it? On Seeking Alpha, you currently have 4 Wall Street analysts rating the stock at 4 holds, which is an improvement from a couple months ago when you had 4 holds and 1 sell. And the current price target for ARR is $5.50, an 8% increase from current prices. Let me know your thoughts below. What do you think of ARR? It's definitely been beat down over the past couple months, but it will be interesting to see what happens to the stock. And let me know, what do you think of these more hybrid, behind the money, Morris Money style videos? Let me know your thoughts down below. And thank you for watching Behind the Money.